Have we hit the bottom for Bitcoin and the rest of the crypto market? We're going to be talking about this and much more on today's episode. I'm Jaime, along with Internet Joey, and together we are New Front Radio. We got a ton of really interesting stories for you guys today. We're going to talk about CPI hitting multi-year highs, the effects on inflation on the average consumer, what's that mean for you. We're also going to touch on the bottom. Are we at the bottom for equities, for Bitcoin, for the crypto market? Elon sells 75% of his Bitcoin position through Tesla earnings, and we'll wrap it up with some really interesting TA on various different markets. Quick disclaimer, anything we say or do is not investment advice. Everything you see here is for entertainment purposes only. Today's date is July 21st, 2022. Let's get into it.
All right. Welcome, everybody. So crazy stuff going on in the market, huh?
Yeah, it's been a couple crazy last weeks. I thought the first story we should talk about is the CPI coming in. I have here an article from CNBC. Last week, we got the new CPI numbers. For those who don't know, CPI stands for Consumer Price Index. It's an instrument that various institutional or financial institutions use to see how much inflation is moving. So here it says the Consumer Price Index, a broad measure of everyday goods and services related to the cost of living, soared 9.1% from a year ago, above the 8.8 Dow Jones estimate. That marked the fastest pace for inflation going back to November 1981. Now, this, for the average person that doesn't know what any of this means, what do I have to worry about? If I'm an average American who just goes to my 9 to 5, I don't know anything about inflation, about what 9.1 versus 8.8 means. What do I have to worry about?
That's a great question. So the reason why inflation is important for everybody, not just people that have investments, right, is because inflation is basically how much your dollar is losing in purchasing power. So when the inflation number or the inflation rate is increasing at a higher pace, basically what your $100 can get you is a lot less than what it could have got you previously, right? And that's simply a supply and demand mechanic kind of going on. So obviously, the more money or dollars that is in the market, the less value your dollar actually has, right? So, when our rates are increasing, the consumers, us, can actually now purchase less with the money we're making. Hence the reason why our quality of life tends to go down. And that's simply because we tend to afford less when, inflation is increasing because the price of goods go up. And that's kind of the whole feedback loop kind of going in and why inflation directly affects us as consumers.
Yeah, and most people are already feeling this. I mean, if you talk to anybody on the street, you'll see them complaining mostly about gas right now. Gas has gone, and I heard in California it hit $6-7 at one point per gallon. Milk, eggs, just the average raw materials to make what the average consumer is buying have gone up all around. And I would argue that the small raise in wages haven't done enough to compensate that. So the average person is definitely struggling, especially if you're in the lower end, lower income to middle end. You're really feeling the effects of inflation right now. And it's crazy. A lot of people don't know in the last 3 years, there's been more printing of money or quantitative easing, QE, which is the modern version of printing money, than in the entire history of the United States. I'm going to repeat that again. The entire history of the United States, there hasn't been so much printing of money than in the last 3 years. That's crazy. I think they printed about $5 trillion in the last 3 years alone. So just imagine how much surplus of currency is out there and how much that's changed our economics over the last couple of months.
Right. And if you look at the M2 money supply, it went from 4 trillion to 16 trillion. So that's a 4x. So yes, the dollar is at an accelerating pace, losing its capability of what it can purchase. Obviously, the U.S. dollar is the world reserve, so it ain't. The idea is that it's not going to go anywhere as long as the U.S. economy can back it. But when what's backing the U.S. economy is the dollar, which is being inflated, it's kind of a catch-22 kind of thing going on. So it's just really interesting times. All in all, the only thing we have is time to see what can unravel. But what's pretty interesting is that, the CPI number is it's basically a basket of goods that the Federal Reserve is tracking to see how they are increasing. Now, what they don't tell you about CPI is that CPI tracks inflation, but it doesn't track true inflation. So with that being said, there's kind of two inflation's basically the mathematical answer that they came up with, but true inflation is the actual number that consumers are basically paying for. And one thing to add on top of that is that CPI, the basket of goods kind of that the Fed is measuring is subject to change. So they basically can, choose different items, and then basket together in 1 month CPI. And then next month they can, let's say they remove steak. Let's say they remove gasoline. Now that whole basket is different. So the CPI is it's not something you can take to the grave with, because it's simply a measure. And as with any kind of statistics that come out from the Federal Reserve, they're all somewhat skewed in favor of whatever the agenda is. So, and if you guys are interested, there is something called true inflation. Oh, I'm sorry. It's called Trueflation. It's powered by Chainlink, and it uses blockchain to actually calculate where actual or true inflation is. So you can actually get some readings on CPI before the CPI numbers actually release. Once again, that's trueflation.com. Powered by blockchain. So it's a pretty cool, interesting application.
And what is the true inflation if we went to that website? If you want to pull it up, let's check it out.
Let's pull it up right now.
Yeah, because that is true what you're saying. I know a lot of people say the CPI is a very manipulated number, along with inflation numbers, because of course the Fed and the Treasury is always going to be manipulating it depending on whatever agenda or goal they have for the economy. So it's not the most reliable number to depend on. Absolutely.
So here is true inflation right on the dashboard. So you can see year to year, the rate is 10.12%. So actually we if you look from the year to year, we kind of peaked out somewhere in March. Yeah, between March and April at 11, let's say 11, almost 12%, 11.5%. And now we're kind of, on the tail end, it looks like. But, once again, the volatility of it, we got to see. Some analysts are actually saying that we've witnessed already peak inflation. And now the Fed is coming out that they're not going to do 100 basis points is kind of out of the books. So maybe the market's pricing in 75% basis points. We're just going to have to wait and see. But as far as Trueflation is measuring, we are actually declining on the actual inflation rate, which would be a good sign, meaning that the Federal Reserve is actually doing their job.
Yeah, it looks like there might be some light at the end of the tunnel, in terms of this terrible narrative of inflation keeping going up and up and not stopping. I saw that CPI number we got was for June, but as you've seen, most of the month of July, most of commodities have started to come down. So we've seen gold, we've seen oil, cotton, wood, all these major raw materials are starting to come down in value, and that should have a ripple effect to the next couple of months and bring down, consumer goods. So that's definitely something to look forward to for the average consumer.
Yeah, we'll go over copper and what that means for the economy as well later on.
Awesome. So let's go ahead and jump into the next story. So the bottom. Joey, what do you think? Did we hit the bottom? I kind of went through Twitter yesterday and this morning trying to see the sentiment for crypto and just for equities in general. And it seems to be 50-50. I ran a poll, and it was just straight 50-50 between everybody. Some people say we're going lower. Some people saying this is just a small pump before the we're going down, and other people says we're going to set new highs. So what do you think is happening? Are we at the bottom?
Awesome. Right. Isn't it always 50-50? Because you're either going up or down. So
I mean, I guess you're right. You can only go up or down, right?
Yeah, unless you crab for the rest of eternity and markets just stabilize. But no, it's a great point. I think so the market is actually forward looking, and I feel like this is something that most retail, average consumers, average investors don't really. I mean, I would hope most investors know this, but the market is forward looking, meaning that the market price you're seeing is actually representative of what they believe the price will be in the future. So what I hear and with my peers and just other fellow investors is that they'll be like, no, you know what, the market has to go lower because this just came out and this just came out. Well, not necessarily, because these things are already priced in. So by the time you hear it on the news, it's actually too late, and it's probably already been priced in. And that's just a good rule of thumb and a good way of thinking, because remember, retail, the average consumers like us, we are the last people to make a move, right? So by the time we're buying the price of something, everything has already been priced in. So if you look at markets right now, we'll get into TA in a little bit, but things have lost some price evaluation. I mean, I don't know the exact number right now, but last time I checked, I think a month ago, the NASDAQ has lost $8 trillion. Yeah, I think it's $8 trillion. Wow. Adjusted for inflation, that's actually more than COVID. I mean, it's way more than COVID. I think COVID, we lost a $4 trillion valuation. It was more than the dot-com bubble, and it was much more than the '08 crash. So the current market correction we're seeing as of today and as of, I think, beginning of the year, the NASDAQ has actually lost more value than in any other correction in the maybe the last 50 years or so. So it's definitely some that it's wild. And then, now you have normal retail saying, oh no, you know what, we're going lower. Yeah. Like we didn't lose. We already have lost so much valuation. No. I think we're going to go lower. And in my opinion, that's what we would call fear, right? That's fear in the market. The market has already lost so much, and now retail is thinking we're going lower. I mean, let's be reasonable here. We've already gone down. Now the market's pricing in. Like I said, it's forward looking. There's actually probably more downside risk than there is upside risk, right? And as Warren Buffett said, buy when there's fear. So, right now no one's ever going to time the bottom. I think everything is probability, and whether or not the markets are bottomed or not, we have to see. From a technical standpoint, and I'll show you the charts in a bit, there are some indications that this can be a local bottom at least. But then again, the macro kind of environment, the macroeconomics that's kind of going on right now is unprecedented. So like I said, it's all risk management, and we just have to see whether or not the market bottoms in.
Yeah, and something else that I have personally noticed over my the last couple years of me trading is usually we get the best news at the tops. So the most euphoric news you get it at the top, and you get the most negative news at the most painful moments at the bottoms. And that actually kind of leads into our next story, where yesterday we got a bomb dropped on us. We found out from Tesla's earnings that Elon sold 75% of his Bitcoin position that he acquired. I believe he got it back in May, if I'm not mistaken. So yeah, that's a lot of money. I believe like $900 million in Bitcoin that he seemingly sold at a loss. I have a story here from Market Watch. It says Tesla sold most of its Bitcoin, 75%, seemingly at a loss. Elon Musk suggests Wednesday, however, that executives will be willing to purchase more in the future while calling cryptocurrencies a sideshow to the sideshow. So not sure what he means by that, but he's kind of giving a little bit of hope for the market. But this is still a really big bomb, and I'm seeing it as an indication that we're probably at a cycle in the bottom, or it's a part of the Bitcoin bottom. And it's funny that it's coming from Elon because if you remember back close to the top, Elon was on SNL, and that was marking the top of the market, and there was max euphoria with Dogecoin, with NFTs, and Elon was really leading the charge on that. So I find it funny that we get some crazy news at the bottoms also relative to Elon.
No, that's a great point. And his name is Alessio. I forget his last name, but he's an analyst. I believe he worked for Goldman Sachs. I follow him. I've been following him for a while. But he actually said something I thought resonated so true, and that was that the news is not the cause, it is the effect. Yep, so news 100%. Does not come first and then the market reacts. Markets price in, then news comes out. And which is kind of counterintuitive. You would think, markets are reacting to news, but it's not true. It is first the markets price in, aka the markets react, then news comes out. And I feel like that in itself is a phenomenal rule of thumb when it comes to investing. And if anything, news is going to shake you out of positions, or it's going to make you buy at euphoria, which neither of you want to do, right? So I was reading an article one time that said, just turn off the news, get off Twitter and stuff like that. And, sometimes that's really just what it takes. So.
Yeah, 100%. I mean, if you've been trading anything for the last couple of years, whether that's crypto or equities, you notice that news is not your friends. I mean, news is put there so the retail buyer and seller can be reactive, and that's how you lose long term. Right.
And it adds to the capitulation. And I mean, just look at Jim Cramer, for example. I mean, this guy is a reverse indicator. Everything he says, you can just counter trade and you'll probably be a millionaire in 5 years. Like, it's super funny. I can't believe I mean, it must be on purpose. He must do this stuff on purpose.
I mean, of course, these huge media sites, media channels, they do this on purpose. I mean, why wouldn't you? If you had control of a show that's getting millions of eyeballs, once you have a pretty big buy order in, well, you just tell everybody to start pumping it. And once you're at tops and you're selling your position, you tell people to keep buying it so you can have a nice, exit liquidity.
Right.
We know that joke gets thrown around a lot in Twitter. You're my exit liquidity, but it's unfortunate, but it's true. In a lot of cases, a lot of newbie investors that get in and they're reactive to news, they end up being somebody else's or a whale's exit liquidity.
Absolutely.
Awesome, man. So let's get into some of that TA that we were talking about. I know you have some prizes stored for us that I don't even know about, so I want to check that out.
Yeah, let's get into it. So we'll just start off looking at the dollar. So the DXY, the Dixie is just a dollar strength. Just a quick note here. We have seen it increasing in strength since the '08 crash where it kind of bottomed. And now it's actually breaking to highs that it hasn't seen since 2000. So wow. It's definitely, it's moving. The dollar is increasing, and that's what tends to happen during a recession. Basically, what happens in a recession is that quantitative tightening. So as interest rates go up, basically kind of closing the faucet of money that's just been entering the market, it kind of makes it harder to acquire capital because now you're paying higher interest. It makes the U.S. dollar, which is the reserve, it makes the supply actually decrease. So the strength increases of the dollar, right? It's simply supply and demand dynamics in play once again. So ever since the quantitative, so here you can see right here on the chart, the quantitative easing that happened in March of 2020 lowered the price of the dollar from 101 to 89, and ever since we started tightening, now the dollar sits at 108, almost 109. That's the highest it wicked to so far, and it's kind of breaking out of this channel. So if you take a measured move from 2014 to when it topped out, it's around 27%, and then you can take that from the local bottom in January of 2021, and the measured move would actually put it to 113. So although the DXY is increasing in strength, it may have a little bit more room to go, meaning markets have not bottomed yet. And then, obviously, once again, you're just weighing the risk to reward because, the DXY may very well be topped as we see. So that's just something to consider is the strength of the dollar. So what that kind of means for Bitcoin is, I'll bring up the Bitcoin chart now. Is Bitcoin, as kind of we see here, has met a local bottom from 17 to 20,000. And so what I have here is the log chart of Bitcoin. I threw on basically a support line since 2015, and it's actually playing that support as we see today. So we're seeing RSI bottomed, which is a pretty good sign on the weekly. The last time it got this low was back in, let's see here, I think it was in 2018, and that's when it dumped down to 3,000. So from 6,000 to 3,000, the RSI was low, and that's at the same RSI level is actually where we're seeing today. We saw that back in June 27th. So it's been a while since RSI has been that low. If you also see on the weekly, we're seeing the MACD look like it's reversing. So the MACD is also pretty low, and it looks like if we see a bullish cross here, that's going to be pretty bullish. And then finally, so I have some fib retracements. They're the level 1 fib retracements from the top to the local bottom. The last 2 data points, they've indicated the bottom. So back in 2015, it indicated the bottom. Back in 2018, it indicated the bottom. And finally, when we take the fib retracement from 69,000 to 49,000, it puts us at 23,000. So we did dump below that a little bit, but now it looks like we're testing it again. And also something interesting to note out is that we're still playing on the 200 weekly moving average. So if we see a close above the 200 week moving average, that's going to be pretty damn bullish. And I think, the possibilities are for at least a, move back to, at least above 23,000 would be pretty good. Any thoughts on that, Jaime?
Yeah, I also see there, we've kind of been, Bitcoin at least has been in a multi-year channel. I'm a really big fan of channels. I draw channels on my charts all the time. And it looks like we're literally hitting the bottom of that channel. So we might get a really strong reversal. I'm just trying to think for the average person who might, wasn't able to buy Bitcoin in 2018, 2019, 2020, is now looking at the charts. Maybe he's sitting on a little bit of cash and is wondering, should I get into Bitcoin right now? Prices are low. Is this my chance to buy? I think at the very least, even if we might go a little lower, this is probably a historically really good chance to buy Bitcoin or any type of crypto because we're pretty low. And if you're looking at the possibilities or the risk of being bear versus being bull, you're probably, getting into a pretty good position. Again, that's not financial advice. But in my beliefs, I think if I was just starting to get into the crypto market right now would be a great time to be purchasing or buying in, or like I know you love to say, DCAing. DCAing is super important strategy for anybody's portfolio.
Absolutely. So if Bitcoin is within the investor's risk appetite, these levels are the levels that would seem like a good entry. And that's just weighing the risk and the risk and benefits. So if Bitcoin is something you've been actually have your eye on and you've been looking to get in, right now, I definitely think is definitely a little opportunity. And remember, greed is going to go both ways. So when things are euphoric, people don't want to sell. When things are dropping, people don't want to buy because they think, oh, well, you know what? It's going to buy lower. I'll buy more when it dumps even more. So greed goes both ways, and you want to that's why, like you said, the dollar cost average just makes so much sense from a risk standpoint, from an investment standpoint. You are just, getting your average in as the market goes up and down. So it's definitely a way to counteract the volatility, especially the type of volatility we see in an asset like Bitcoin.
Awesome, man. Awesome.
Yep, and next up, so I'm going to go over a little bit something called the market breadth. So this is basically the S&P, the Nasdaq, and how many of the companies are actually below its 200-day moving average. So you can see the majority of companies are actually below their 200-day moving average, and when companies in the NASDAQ tend to go below the 200-day moving average, all kind of simultaneously, it does indicate that we are approaching a bottom. So this is something to kind of keep in mind. It's indicated several bottoms in the past. Obviously, past performance is not indicative of future performance. Yeah. But what we have here, according to the market breadth, is that, markets are looking, or companies are at least looking a little bit under evaluated. So I just thought that'd be something, that is interesting and you can take into consideration. Next up.
When was the last time? I'm sorry. I was going to ask, when was the last time it was down at that price level?
In the COVID drop. And then
back in 2020.
Yep, and then it was back in 2020, and then the last one after that, I believe, was 2008, so the financial crisis, and then 2000, the dot-com bubble. So it is a pretty good indicator. And then if you pair that alongside so this is the 10-year, the 10 to 2-year bond inversion. Bond yields are actually inverted now. So we did bounce at 0%, and now we are actually completely inverted at negative 0.2%. So, this is kind of worrying because this is when yields inverse this aggressively, that's when we tend to see the final drop, or at least even more capitulation. So, that the bond yields is definitely something to be concerned about. And then finally,
that's a really cool chart. I hadn't seen that one.
Yeah. So that's definitely, you basically take the 10-year divided by the 2-year or the yields, and then you see, how the ratio is. And right now, I believe the 2-year is paying more than the 10-year, which doesn't make sense. Obviously, if you borrow money, the longer you borrow it out for, the more interest you should receive. So if right now the 2 years are making more money than the 10 years, something in the economy is wrong. So basically, it indicates market inefficiency.
I see. That's interesting.
And finally, I want to go over, this is a quick chart. This is called the PMI. So what you have here, PMI basically stands for Purchasing Managers Index. And what this consists of is basically, it summarizes whether market conditions viewed from purchasing manager's point of view are expanding, staying the same, or contracting. And that's kind of what this chart shows us. So when you look at the PMI right now from April of 2021, we've been the PMI index has actually been contracting. And it has not, and it's almost at 50%. So this is something else to keep an eye on, because there actually would be room to go down to a multi-year resistance level at 33. So basically hedge fund managers, people that manage accounts and stuff like this, they have room to contract, so they have actually room to sell. Not meaning they're going to, but it just indicates that they haven't bottomed yet. And that's just something else to keep to consider when you want to have an idea on what institutions may be doing, hedge funds and stuff like that. So once again, the PMI is it's almost halfway. It may reverse, but all in all, it does have some sell pressure if managers decided to start offloading. Gotcha.
That's some really interesting stuff. A lot of alpha information that we have to consider. My only real question to you, Joey, is, for the average American who maybe is just living paycheck to paycheck, you're just, getting enough money to to pay your bills, pay your rent, and maybe buy some food for your family. I mean, inflation has definitely hurt you a lot. Should I be worried about the next 3-4 years? Because they keep hearing recession, and they have nowhere to run. Is there a potential of, hey, we're going to see food lines because of a major depression like in 1929? Is that a possibility? Isn't that cards?
Well, I wasn't alive for the Great Depression. I'm sure that was a terrible time. Look, this is kind of what I would say, and at least this is kind of what helps me, is that there's nothing to be worried about because all of these things are somewhat out of your control. So I feel like, I don't know if this is like a Buddhist philosophy, but you should only worry about things that are in your control. So what the market is going to do, the market is going to do. The best thing we can do as consumers, investors alike is to prepare. So I would be, number one, getting, as long as you can pay your bills, continue to bring in the income, I would actually be entering during a time of fear, right? So now you have money, some money saved up. I think right now during these lows, the market's on a discount, although be it the economy may not be as strong as we think. It's still a good time to start building a long-term position. And then finally, with that being said, you also want to obviously have some cash for maybe an emergency. But if you do have the capital available to start investing, this is, I would say, not financial advice, this is the time. Because you don't want to be investing when Amazon is $5,000. Because where else is, for example, is Amazon going to go? To $10,000 per share? The evaluation is already so high. So when the market pulls back, when economies reset, everything tends to be devalued. And that's when you would want to start investing, not when evaluations have already maxed out. And a stupid idea is like, when you buy gas, when you put gas in your car, do you put gas when the tank is already filled as much as it can go? I mean, the gas doesn't fit, right? Obviously, that's foolish. So you would do it when the gas tank is empty, and then you can fill up. And that's kind of how I would look at building a position into any investment asset.
Awesome, man. I couldn't agree more. I think we've had a pretty amazing show today. Next week, we're going to have a special guest. We're going to be talking a little bit about Airbnbs, a little bit about credit. His name is Migo. You guys are really going to enjoy the show. And before I let you go, Joey, I just kind of want to ask you from today's Thursday, the 21st, to next Thursday, where do you think the market's going to be? Bullish or bearish?
Sheesh. Put me on the spot.
I'm not going to hold you to it. Just bullish or bearish Bitcoin.
Let's see. Weekends are always interesting, but I'm going to be leaning towards more of the bullish side. I think at least very short-term bullish, at least for right now, before we see a major, or not a major, but at least a correction. I think there's still some upside to go. And then we'll see kind of maybe a correction back. But I think markets haven't pumped enough for it to correct just yet. I could be wrong. Ethereum, which is pretty crazy. Ethereum has increased almost 90% since its local bottom. So Ethereum may be overextended, but I think Bitcoin itself has some more room to run. If it closes above that 23,000, we're probably going to be in the money. As far as equities, we have to see, but I'm gonna call bullish for the next week or so.
All right, I love it. I'm gonna join you on that prediction. Bitcoin is currently at 23,100. I'm also gonna assume bullish by next Thursday. So we'll see if our predictions come true.
All righty, sounds good. All right, thanks for tuning in, everyone.
Right.
That was great. Thank you, Jaime.
Thank you, guys, and don't forget to like, comment, and subscribe. And if you have any recommendations for us, go ahead and leave a comment down below. All right? Thank you, guys. Have a good one. Bye-bye. Bye-bye.